The near-term outlook for enterprise software suggests a potential revenue boost as companies begin deploying AI agents across their enterprise user bases. Against that backdrop, it is important to evaluate where growth is actually occurring, how that growth translates into earnings, and how current valuations compare once adjusted for those growth rates. The key point is that growth profiles across this sector are materially different, and valuations must be interpreted in that context rather than viewed in isolation. Consider a large, mature enterprise software provider such as Salesforce, ticker CRM, with a market capitalization of approximately $230 billion. Salesforce is expected to grow revenue at roughly 10%, which is not exceptional, but is notably consistent for a company of its size. Expected earnings for the year are approximately $11.70 per share. By contrast, a company like Snowflake is operating on a very different growth trajectory. Snowflake is expected to grow revenue by about 28%, reaching approximately $4.6 billion. That stronger growth profile largely explains why the stock has performed well over the past year, even amid broader concerns around enterprise software and AI-related spending. When examining valuation, Snowflake is trading at roughly 16 times price to sales, meaning investors are paying nearly $16 for every dollar of reported sales. Salesforce, by comparison, trades at approximately 5.7 times price to sales, or about $5.70 per dollar of sales. On the surface, Salesforce appears significantly cheaper. However, these figures cannot be compared directly without adjusting for growth, because Snowflake's sales are expanding at a much faster rate. Paying a higher multiple can be justified if the underlying growth is materially stronger. To make this comparison more meaningful, valuations can be adjusted by sales growth. For Salesforce, dividing the 5.7 price-to-sales multiple by its roughly 10% revenue growth results in an adjusted ratio of approximately 0.57. Applying the same approach to Snowflake, dividing its 15.98 price-to-sales multiple by its 28% growth rate also yields an adjusted figure of approximately 0.57. On a growth-adjusted basis, the two companies are effectively valued the same. At that point, the analysis shifts toward qualitative and profitability factors, such as competitive positioning and margins. Snowflake currently operates at a negative operating margin of approximately 27%, meaning it is still losing money at the operating level. Salesforce, in contrast, reports an operating margin of about 24%. This implies that while both companies trade at similar growth-adjusted valuations, Salesforce is in a stronger position due to its established profitability alongside steady growth. Extending this framework to other enterprise software companies provides additional perspective. Workday, growing revenue at approximately 13% annually, trades at about 5.83 times price to sales. When adjusted for growth, this equates to roughly 0.45, making Workday cheaper than both Salesforce and Snowflake on a growth-adjusted sales basis. ServiceNow is another major enterprise software provider with a market capitalization of roughly $145.5 billion and shares down approximately 32% over the past year. ServiceNow is expected to grow revenue at around 20% this year, moderating slightly to 18% next year, but still maintaining a strong growth profile. With a price-to-sales ratio of approximately 11.4, dividing by its 20% sales growth again yields an adjusted valuation of about 0.57. Notably, Salesforce, ServiceNow, and Snowflake all converge around this same growth-adjusted price-to-sales level. From there, deeper analysis requires examining earnings growth and cash flow. For ServiceNow, expected earnings of $3.48 compared with $2.78 last year imply earnings growth of approximately 25%. With a price-to-earnings ratio near 83, dividing by that 25% earnings growth results in a price-to-earnings-to-growth ratio of roughly 3.3. Salesforce is expected to generate about $11.77 in earnings this year, compared with $10.20 last year, representing approximately 15% earnings growth. That indicates operational leverage, as 10% sales growth is translating into 15% earnings growth. With a price-to-earnings multiple of roughly 32, dividing by the 15% earnings growth produces a PEG ratio of approximately 2.13, which is lower than ServiceNow's. Snowflake, while still relatively expensive, is expected to deliver approximately 45% earnings growth, driven by roughly 28% revenue growth. Using its valuation, this results in a price-to-earnings-to-growth ratio of approximately 3.8. Among the three, Salesforce emerges as the least expensive when adjusted for both sales and earnings growth, supported by strong margins. ServiceNow appears moderately more expensive, while Snowflake remains the most expensive but also offers the highest growth. After addressing enterprise software, attention turns to Supermicro Computer, ticker SMCI. Shares declined approximately 5% following Goldman Sachs reiterating a sell rating with a 26 price target, citing further downside risk to margins. This rating is not new. Goldman Sachs has maintained a bearish stance on SMCI for some time. Importantly, even within that bearish framework, the analyst acknowledges that SMCI remains a leader in AI servers, particularly within Tier 2 cloud and neo-cloud segments. According to Goldman Sachs, SMCI held a 27% market share in the third quarter, up from approximately 3.5% in 2021, and is targeting roughly 30% market share alongside revenue, exceeding $36 billion this year. This rapid expansion underscores a durable competitive advantage. The company is widely regarded as having differentiated product engineering that enables more efficient and effective server solutions than competitors. That differentiation explains why infrastructure builders increasingly rely on SMCI. Despite this, the stock has been highly volatile, repeatedly oscillating between roughly $30 and $60 per share over recent periods. From an analyst perspective, consensus data shows 12 Wall Street analysts covering SMCI. While Goldman Sachs maintains a $26 target, the average target price is close to $45, implying approximately 56% upside, with a high target of $63, representing roughly 120% upside. Despite this, the stock frequently sells off sharply following reiterated bearish commentary, even when no new information is introduced. Fundamentally, SMCI is expected to deliver approximately 65% revenue growth this fiscal year, reaching around $36 billion, followed by roughly 22% growth next year to approximately $44 billion. However, earnings are expected to remain roughly flat this year, with earnings per share declining slightly from $26 last year to about $25. This divergence between revenue growth and earnings growth is central to Goldman Sachs' bearish thesis. Profitability metrics highlight the issue. Gross margin has declined from approximately 18% in 2023 to around 10% recently. Operating margin has fallen from roughly 10.7% to about 4.4%. This compression reflects intense competition from Dell, Hewlett-Packard Enterprise, Foxconn, and other server manufacturers, all competing aggressively on price amid rapid AI infrastructure expansion. SMCI has lowered prices to defend and grow its market share, which has eroded margins. Looking ahead, while earnings are expected to be flat this year, estimates point to roughly 50% earnings growth next year as pricing pressures ease and scale advantages translate into profitability. On valuation, SMCI currently trades at approximately 0.91 times sales, meaning investors are paying about 91 cents for each dollar of revenue. Goldman Sachs has compared this to Dell, which trades at roughly 0.8 times sales, but Dell's revenue growth is only about 16.6%, far below SMCI's expected 65%. When adjusted for growth, SMCI's valuation appears materially more attractive than that comparison suggests. The combination of strong revenue growth, dominant and expanding market share, and the potential for margin recovery underpins